Yesterday we saw that the Nifty IT index posted one of the best days that we've had in the recent past. In fact, it was the best performance that we saw from the IT index since 15th of July this year. And it was primarily led by HCL Tech that grew more than 10% and posted the best day in 19 weeks. Not too far behind were the other heavyweights, the likes of Infosys as well as TCS. TCS gained the most since 28th of July, while you had Wipro that surged the most since 15th of July as well. And Infosys also posting the best day since 20th of July. When you have such kind of days, there's a lot of wealth that these companies actually create and add a lot of market capitalization to themselves. The 5 Nifty IT companies yesterday added market capitalization in excess of 80,000 crores. Now remember that out of this 80,000 crores, more than 40,000 crores was contributed by TCS alone. TCS is India's second largest company after Reliance Industries, and yesterday it also became India's second company to boast of a market capitalization in excess of 9 lakh crores. But with all of this and the sudden up move that we have seen in the IT stocks, what has actually happened is that now the IT index is trading well above what the analysts were expecting. So just to give you a number, the IT index trades above the fair value that analysts expect it to be by more than 7.5%. And this is the biggest margin that we have seen in over a year as well. A lot of the other stocks also that trade within this basket, those have surpassed the expectations. Let me just highlight those also for you, which is except for Infosys, which is 2.5% below its target price. There's a lot of other stocks that have exceeded their expectation by more than 10% or so. Starting off with TCS itself, of course, we have 12% gap between the actual price and the target price. Mindtree 14% above the target price, whereas you have Info Edge and Coforge India, which are 15% higher as compared to their respective target prices. And you have Wipro that has been beating the lot with a 17% gap between the actual price versus the target price as well. Also, if you have a look at the valuation picture, that looks a little bit stretched at the moment, because you have the estimated price to earnings multiple which stands at about 23 times as compared to the long-term average since 2007, which is nearly 17 times. The one standard deviation above that 17 times is 19.5, whereas the two standard deviations above this is about 22.5 times as well. So definitely on the valuation front looks a little bit stretched, and the IT index has managed to trade 3 standard deviations above its mean only once, which is back in 2007, and that level stands at about 25 times. But definitely, as if you look at the valuation front, the IT stocks look a little bit overstretched, and as per analyst expectations also, most of them have exceeded those as well.